Let's review chapters 25 and 26. So starting off here with question number 1. Bosch Company purchased at a cost of $30,000. So they purchased and used 6,000 pounds of materials during March. Their standard cost of materials per unit produced is based on 4 pounds per unit at a cost of $6 per pound. Production in March was 1,400 units. Using all of that information, we now need to compute the total price and quantity variances for materials. Now, before we do that, it'll be best to figure out each of our individual pieces, right? Our actual quantity, actual price, standard quantity, and standard price. So actual quantity, that's our 6,000 pounds, right? That's how many pounds of materials we actually used during the month of March. Actual price is how much did we spend per pound. It tells us that we spent $30,000. That was for 6,000 pounds. So we divide those two and we see that we actually spent $5 per pound. Standard quantity, we're going to want to take our actual production, our 1,400 units, multiply it by that 4 pounds per unit that we see up above. So that will give us our 5,600 for our standard quantity. Now standard price, that's just our $6 per pound. That was given to us in the problem. So now that we have all of those in the upper left, we can now work on finding the total price and quantity variances. So we're going to set it up like this. So we see AQ times AP, AQ times SP, and SQ times SP. If we find those three values, we can then figure out all of our variances. So the difference between AQ times AP and AQ times SP will be our price variance, because the variable that changed there was the price, right? And the first one, it was our actual, second one was our standard. Then, if we take the difference between AQ times SP and SQ times SP, that will give us our quantity variance, because the variable that changed there was our quantity. Then once we have the price and quantity variances, we can use those to find our total variance. So let's start filling in our numbers here, right? So AQ times AP, that's 6,000 times 5. AQ times SP is 6,000 times 6. And SQ times SP is 5,600 times 6. So if we multiply these out, we'll get our 30,000, 36,000, and 33,600. Now to find the variances, we need to subtract them. So for the price variance, we take the 30,000 minus the 36,000. So there's a difference of 6,000 here. Now for variances, we are going to need to know if it's favorable or unfavorable. So in this case, we actually spent $30,000. If we would have based it off of our standard price, our expected price, we would have spent $36,000. So since we spent less, this is favorable. Now our quantity variance. We're going to take the difference between our 36,000 and our 33,600, and we get this $2,400 amount. Here we're thinking about quantities. We actually used 6,000 pounds. Based off of our standard, we would have expected that we would have had to use 5,600 pounds. So since we used more in materials than what we expected to have to use, this is unfavorable. So now for your total variance, we're going to look at that 6,000 favorable and 2,400 unfavorable. So we can see the difference there with the favorable and unfavorable. Think of that as different signs, right? The favorable can be positive, the unfavorable can be negative. So we're going to subtract those two. And that will give us a difference of 3,600, right? Since we have more favorable than we do have unfavorable, this 3,600 will be favorable. Now question number 2. This one says McCarthy Company's standard labor cost of producing 1 unit is 3 hours at a rate of $17 per hour. During April, 42,000 hours of labor are incurred at a cost of $18 per hour to produce 12,000 units. We need to compute the total, price, and quantity variances for labor. It's a lot of the same steps, we just have some different terminology for it. So you can see we have our variables once again in the lower left. It's our actual hours, actual rate, standard hours, and standard rate. So that's the same kind of idea as what we saw earlier with actual quantity and actual price, right? But since we're talking about labor, we have some different names for it. So our actual hours, that's the 42,000 hours that we had during April. Actual rate, we were told that was 18. Standard hours, we're going to take the 12,000 units that we produced, multiply that by the 3 hours that we expect to have to use in order to produce a unit. And then our standard rate is just that 17. So now that we have all of those variables, we can find our variances here. We set it up in the same kind of way. Actual hours times actual rate, actual hours times standard rate, and standard hours times standard rate. The difference between those first two will be your price variance. Difference between the last two will be your quantity variance. And then we can use those to find our total variance. So we plug in all of our numbers that we had already found, right? We already know that our actual hours is 42,000. We already know that our actual rate is 18. So we plug those in for each of those, multiply out, and we get our numbers. So looking at our price variance here, actual hours times actual rate came out to be 756,000. Actual hours times standard rate came out to be 714,000. We want to take the difference of those two, and we get this 42,000 amount. And then we need to think about if this is favorable or unfavorable. In this case, we actually spent $18 per hour. Our standard, our expected amount, was only 17. We spent more per hour than what we thought we were going to have to, so this is unfavorable. Now we can find our quantity variance. We take the difference between the 714 and the 612, and we get this 102,000. Once again, we need to think, is this favorable or unfavorable? Well, this is the quantity variance, right? So we're looking at actual hours versus standard hours. We expected to have to spend 36,000 hours making this product. We actually spent 42,000 hours. So since we had to have more hours of labor than what we would have expected, this is also unfavorable. So now when we find our total variance here, you'll notice that they're the same sign, right? They're both unfavorable. So when they were different, we subtracted them. When they're both the same, we add them together. So we take the 42,000 unfavorable plus the 102,000 unfavorable, and that gives us 144,000 unfavorable. Now question number 3 says Parsons Company manufactures and sells homemade wine, and they want to develop a standard cost per gallon. The following are required for the production of a 50-gallon batch. So to make 50 gallons of wine, we need 3,000 ounces of grape concentrate at 6 cents per ounce, 54 pounds of granulated sugar at 30 cents per pound, 60 lemons at 60 cents each, 50 yeast tablets at 25 cents each, 50 nutrient tablets at 20 cents each, and 2,600 ounces of water at half a cent per ounce. Then it tells us that Parsons estimates that 4% of the grape concentrate will be wasted, 10% of the sugar is lost, and 25% of the lemons cannot be used. With that information, we can now compute the standard cost of the ingredients for 1 gallon of wine. So what we're going to want to do is we're going to want to create a table like this. So you can see that we have all of our ingredients listed over on the left. Then we have amounts in 50 gallons, amount per gallon, standard waste, standard usage that we'll talk about in a little bit, standard price, and then standard cost per gallon. So the amount in 50 gallons, those were given to us there in the middle, right? The 3,000 ounces of grape concentrate, the 54 pounds of sugar. So we can just pop those in to our table. So we know how many of each ingredient we need in order to make 50 gallons. But our goal here is to find a standard cost per gallon. So we want to divide all of those by 50. So for grape concentrate, it'll be 3,000 divided by 50 to get us 60 ounces. Sugar, 54 divided by 50, and that will give us all of our amount per gallon. So now that we know that, that tells us what we need in 1 gallon of production. Now, standard waste. We were told that a certain amount of the grape concentrate wasn't going to be able to be used. A certain amount of the sugar wasn't going to be able to be used. So we'll plug those in there. So it's 4% of our grape concentrate we were told won't be able to be used. 10% of the sugar and 25% of the lemons. You'll notice the yeast, nutrient tablet, and the water. There's no standard waste there. We expect that all of that will be good to go. Now, standard usage. This is where we need to figure out where if 4% of the grape concentrate is going to be wasted, how much grape concentrate do we need to put into 1 gallon or expect to use up for 1 gallon to be able to make a gallon of wine? The way that we're going to do this here, since there's 4% waste, we're going to take 0.96x, x is going to be our standard usage, equals 60. So we get the 0.96 by taking 100% minus our 4% waste. That's how we find the 0.96. The 60, we can see that that's our amount per gallon. So if we take 0.96x equals 60, in order to find x, we need to divide each side by 0.96, and that will give us the 62.5 ounces. So that's our standard usage for grape concentrate. Now for sugar and for lemons, there's 10% waste for sugar and 25% waste for lemons. So for sugar, that's 0.9x equals 1.08. That 1.08, we got that from our amount per gallon for sugar. So that tells us that we'll need 1.2 pounds of sugar for our standard usage. Lemons, 25% waste, so that we're all the way down now to 0.75x equals 1.2. Tells us that we need 1.6 lemons when we divide each side by 0.75. So we can plug those in as our standard usage into this table. Now for the yeast tablets, nutrient tablets, and the water, there's no waste, so it's the same for standard usage as it was for the amount per gallon. Now standard price. We were given our standard price at the very beginning of this problem. We were told that grape concentrate is 6 cents per ounce. Sugar's 30 cents per pound. So we're just going to plug those in there as our standard price. And using those amounts along with our standard usage, we can now find the standard cost per gallon. So for grape concentrate, 62.5 ounces times 6 cents per ounce tells us that that's going to cost $3.75 per gallon. Then we multiply out for the others. Sugar, 1.2 pounds times 30 cents. Lemons, 1.6 lemons times 60 cents. And when we multiply all those out, we'll get these values as our standard cost per gallon for each individual ingredient. Then we need to find the standard cost per gallon for the entire recipe. So the standard cost for 1 gallon of wine will just be the sum of all of your standard costs that you just found. The $3.75 plus the 36 cents plus the 96 cents. We add all of those values together and we see that the standard cost for 1 gallon of wine is $5.78. Now, question number 4. We're going to need to prepare a flexible budget performance report for December. So we have some budgeted costs and we have some actual costs. So we were told that the budgeted selling expenses and the actual selling expenses incurred in December 2019 by Myers Company are as follows. So you'll see that they are slightly different, and some are the same, right? Our sales salaries, our depreciation, our insurance, those are all the same because those are going to be fixed expenses. So this is what a flexible budget performance report will look like. You'll have all of your budgeted values on the left, then your actual values on the right, and then we can figure out the difference over on the far right. So our sales for our budgeted amount was the $170,000. And then we fill in all of the budgeted amounts that we were given on the last slide, right? We were given all these budgeted costs. So we just fill those in under the budget column. Now for actual, well, we know our actual sales was $170,000. Our actual sales commissions were $11,000. So that's $800 more than what we budgeted for, right? So the difference is $800, but we also will want to say that that's unfavorable because we had more in sales commission costs than what we expected according to our budget. Now advertising, that was $6,900. So that's $100 more than what we expected. So that's $100 unfavorable. Traveling was exactly the same. So there is no difference there. Delivery, that was $50 more than our budgeted amount. So that's $50 unfavorable. We add up our 4 variable costs here and we get this $26,450. Now, a few different ways that we can figure out what goes over into the difference column here. We could take the difference between our total variable costs for our budget versus our actual, or we could look at the 4 differences that we already have. We have 800 unfavorable, we have 100 unfavorable, and we have 50 unfavorable. If we think back to when we did that, those variances at the beginning of this review, if they're all unfavorable or if they're all favorable, they're all the same sign, right? So if they're all the same sign, we can just add those together and we can find it to be 950 unfavorable. Now we can double check that looking at our total variable costs for budget versus actual. We budgeted $25,500. we actually spent $26,450. That's $950 more than our budget, which would also give us this $950 unfavorable. Now for our fixed costs remain the same. Those did not change between our budget and our actual. So we don't have any differences there all the way down through our total fixed costs. Now for total cost, the way that we find this value is we take our total variable plus our total fixed. So we're going to take our $26,450 plus our $43,000, and we get $69,450. So a few different ways that we can find what goes over into the difference column here. The first way is to take the $68,500 that we have over in our budget column, and we compare it to our $69,450 in the actual column. We can see that there's a $950 difference, and we spent $950 more than what our budgeted amount was, so it becomes unfavorable. The other way that you could find that value is you take the $950 that we have above for our total variable cost, and then we look at the total difference for the total fixed cost. In this case, that was a 0. So $950 plus 0 still leaves us with this $950 unfavorable difference. Now question number 5 says Division A of Batista Company reported the following data for the current year. So we have sales data, variable cost, controllable fixed cost, and average operating assets. Top management is unhappy with the investment center's return on investment, the ROI. And it's asking the manager of Division A to submit plans to improve the ROI in the next year. The manager believes that it's feasible to consider the following independent courses of action. So they could do A, B, or C. A says increase sales by $300,000 with no change in the contribution margin percentage, or the contribution margin ratio would be another way to word that. B says reduce variable costs by $150,000. And C says reduce average operating assets by 4%. So what we need to do is we need to first compute the ROI for the current year before doing any of those independent courses of action. Then, using the ROI formula, we need to figure out the ROI under each of those courses of action to figure out which one is the best. So we have everything that we were given for the current year in the upper left. And then we see that our ROI formula is controllable margin divided by the average operating assets. So average operating assets we were given, that's the 5 million. Controllable margin we were not given. So we're going to need to find that. So you'll see that in order to find it, we take our sales minus our variable cost, which will give us our contribution margin. Then if we subtract out our controllable fixed costs, that will give us our controllable margin. So we had 3 million in sales, 1,950,000 in variable costs. So that gives us our contribution margin. Then we subtract out the 600,000 in controllable fixed costs to tell us that our controllable margin is 450,000. Then we can plug that into our ROI formula. So we have the 450,000 divided by our 5 million. That will tell us that our ROI is 9%. So that was the ROI for the current year. Then we can look at our 3 different independent courses of action, right? So the first one was increase sales by 300,000 with no change in the contribution margin percentage. So that was our original, right? That's what we found in the last part. We need to figure out what this contribution margin percentage is. So sales is always 100% of itself. Variable costs is 65% of sales. So if you took the 1,950,000 divided by the 3 million, that's how you find that 65%. And then we know that sales minus variable costs will give us contribution margin. So 100% minus 65% gives us this 35%. So that's our contribution margin percentage. We're going to use that now to fill out our new information over here. So sales is going to be 3,300,000 because we increased by 300,000. Variable costs are 65% of our sales. So we find that to be 2,145,000. Contribution margin is 35% of our sales. So that's 1,155,000. Our controllable fixed costs, those are still 600,000. There was no mention of those changing, which will make our controllable margin $555,000. So now that we have that, we can plug that into our ROI formula and see that the ROI for this first course of action that we could consider is 11.1%. Now our next part said reducing variable costs by $150,000. Okay, so there's our original. Then we need to fill out our new information. Sales goes back to just that 3 million. Because remember, these are independent courses of action. So our sales remain at that 3 million amount. Variable costs, this is the piece that's going to change. It was 1,950,000. We're going to reduce that by $150,000. So our variable costs become 1.8 million. Contribution margin is sales minus variable cost. So we get 1,200,000. We'll then subtract out our controllable fixed cost of 600,000 to find our controllable margin to be 600,000. Now that we have that, we can plug that into the ROI formula. So 600,000 divided by 5 million leaves us with an ROI of 12%. Now our last piece here is reducing average operating assets by 4%. So we have our original information over there, but this time we need to think about our average operating assets. They were 5 million. We're thinking about reducing them by 4%. So we take 4% of that 5 million. Leaves us with 200,000. So we need to reduce our average operating assets by 200,000. So we subtract that from the 5 million. That leaves us with the 4,800,000 as our average operating assets in this example. Now that we have that, and we have the controllable margin from the original information, we can fill in the ROI formula. So the 450,000 divided by the 4,800,000 that we just found as our new average operating assets leaves us with an ROI of 9.375%. So we've figured out the ROI for each of these different courses of action, right? So we need to figure out which alternative is best. So originally, that current year, that was just at 9%. Alternative 1, which was increasing our sales, left us with an ROI of 11.1%. Alternative 2, reducing the variable costs, left us with an ROI of 12%. And alternative 3, reducing the average operating assets, left us with an ROI of 9.375%. So each alternative is better than the original ROI, right? We want a higher ROI. So each of these alternatives will be better than what we were doing originally. We need to pick which alternative has the best ROI. That's alternative 2 with an ROI of 12%. That was when we reduced the variable costs by $150,000.